This stuff allows you to make wise decisions.
Yeah.
That increase your potential upside and mitigate risk.
It gives you that competitive edge.
And so now all of a sudden you have demand for 1,000 new apartments because of a job announcement of 500 jobs. These numbers are uncovering questions that we got to make some assumptions on the front end. If we want to move forward, we got to bear out those assumptions. So we have to go investigate and turn those assumptions into hard numbers. You can't tell me that's not fun. And that's where you can make some decisions that make you some money.
Yeah, baby. And that's what this is all about, making decisions that make you money.
You can figure that out ahead of time. I'll show you how to do that. Smart feller.
I'm a fart smeller. A smart feller. That's right. That was one of my favorite jokes Dad would say.
Yep.
You're a fart smeller. I'm sorry, smart feller.
Yeah.
Well, hey, I've got a trick for you.
All right.
I got a magic
I'm
card
excited.
trick.
I'm excited.
So, and I also want to say, too, if you are listening to this podcast, maybe you're on Apple Podcasts and you're listening, first of all, you can leave us a review. That really helps, a big deal. Or shout out all the reviews. We love those reviews.
Yep.
Makes us feel good. Big shot of dopamine. But also, there might be a lot of you listeners that don't realize that there's a whole video aspect to this podcast.
Yep.
And today, and actually the last couple episodes, we showed a lot of stuff on the computer. I'm talking to the mic like, hey, listener, there you are. There you are. So, yeah, all the podcast listeners probably don't know we got cameras. If you go to Spotify or YouTube, you can watch the episode. I don't think we ever say that. Yeah.
Every single episode is a full video.
Every single one. We're like an episode away from 60 episodes. Can you believe that?
No.
That's crazy.
That is pretty nuts.
Yeah, it's nuts. And now we're starting to see a little bit of growth, too. Finally, man.
People keep asking me, like, how are you doing with the show and stuff? And I'm like, I have no clue.
Yeah.
Like, I know what our numbers are, but I don't know what they're supposed to be. Like, I have nothing to compare it to, so I have no idea.
That's right.
You know, what you got for me, man?
All right. Pick a card, any card you like. Look at it. Don't show it to me.
Okay.
You got it? All right. Just put it on top there. Now, as I shuffle this, cut through, shuffle it all up, I want you to think of a name, right? But not like an obvious name, like somebody in the family. Just try to think of a random name that I would be like, oh, I had no clue that you would say that name.
Okay.
Okay? And I'm just going to cut this deck up a little bit. Give it a shuffle. And you let me know when you have the name.
Oh, I got it.
You got it? Okay, cool. More cuts. All right. What's the name?
Oh, I thought you were going to guess. Now I'm disappointed. It's Posentrotten.
What is it?
Posentrotten.
Posentrotten. How do you spell that?
I have no idea. Hold on, I'll write it down.
Okay, yeah, write it down. Because the next move here, I gotta spell that name.
Okay.
All right. Great. And you're gonna do this. I'm gonna show you exactly what you're about to do.
Okay.
Okay. POSENTROTTE, and then the last one you flip over.
Okay.
Okay, but the magic doesn't happen in my hands. The magic happens in your hands, right? So I'm just going to give it one more little cut. Are you ready?
Mm-hmm.
Do you need to look at the name?
POSENTROTTER.
Yeah, R. Is that it?
Yep.
It was?
Yep. That's pretty good.
That's pretty good, huh?
Except I think I've got this one.
You do?
We've never really done it like this, but
No, please.
Can I try to?
It'll do nothing but improve my game, yeah.
Now, the cool cutting you were doing, you never actually put them together. So, like, once I put my card on the top, I could actually follow it the whole time. And then when you showed me what I was going to do, you took my card, which was the P, and you turned it into the N.
Yeah.
Because of the way they put down, and then you just put them back on top, and I could follow the card I put down the whole time. Is that how it works?
Yeah.
Okay.
Yeah. So like my whole thing that I'm wanting to get better at is my card control.
In this case, you know, because you've shown me some tricks. I've never really been able to figure out how you do it.
Right.
You know.
Right.
So I was really paying attention.
Yeah.
You know.
Well, good. But that's good for me because I'm like, oh, I got these fancy things, but I don't know exactly how it looks to somebody else. And now I know, like, oh, I got to do it in a way that it's not so obvious. But, like, if I were to show you this card, and then I show you that, like, I put it right in the middle there, right? And then I can do a series of cuts and a shuffle.
The other thing I noticed that you did is when you shuffled, you made sure that was the top card was still the top card.
Oh, right.
And it was it might have been like 8 cards heavy on the top from that side.
Oh, yeah, a little too heavy.
And if it weren't that heavy, I bet I wouldn't have picked up on that either.
Yeah.
But anyway.
Okay.
Yep.
Okay. That's all good things. That's all good things. So you saw me put in the middle. And then I shuffled and did a couple cuts. So, I mean, would it be weird if it was there? Yeah, okay.
The only thing I wonder now, and I'm just trying to like conceptualize how that might have worked.
Sure.
Is when you put it in the middle, like I couldn't see the back end of it, and if you left a tail and then cut it, like you could have made sure that that second pile had that one on top, and then you still knew where the card was.
Oh, yeah. I put it in, and I created like a little break in the cards where I had it, and then, when I did my cuts, I put it where I wanted it to go.
Yep.
Yeah, that's accurate. Yeah, that's correct.
Cool.
But then I also threw this one in there, where I do this, right? And then we'll do the cuts again like that. Did they look like they were all together? And then
More so, I think.
Yeah. I'd even do a few more cuts. I'm not sure what was on top.
Well, that's still my card.
Uh-huh. Oh.
That card stayed on the top for a long time.
For a very long time. Or it made its way back to the top. I did not know what was on the top. It just so happened to work out. Yeah. Okay, cool. Thanks for indulging me.
Yeah, no problem.
That was for you, Brad Arns, and you, Jay Barron. And then the rest of you listeners, I don't know by name who haven't done it to you. But, you know, you're silently there just waiting for me to do more magic. I can just feel it. That's for you.
All right, let's get to it. You want to get to it?
Yeah, what are you teaching me today? Oh, this is an exciting day, actually.
It is.
Yeah.
And we're actually going to do a market analysis of a market. So we had...
Sorry. Welcome to Commercially Speaking. I'm Timmy Barron, ADHD.
And I'm Bo Barron, CCIM.
And he's teaching me everything commercial real estate because, boy, do I want to learn it.
Well, you're going to anyway.
I'm going to, and I'm very happy to as well. Yeah. All right. Sorry. Go ahead. Market analysis.
Yeah, so we had a contest, right? You guys wrote in by leaving comments on YouTube and other places and you put your market up
for us
in the hat.
Yeah.
Yeah, and so last time we drew from the hat, and what's the name of the guy who won?
Scott Carlin.
Yes, that's it.
Scott Carlin was the winner. And before we move on to the past 2 episodes, so last week and the week before, you all, Bo showed me the tools that he uses to figure out the people, their demographics, and who they are and how they think, which was one of my favorite episodes. I just saw how exciting it can be to be a commercial real estate professional. And then last week, Bo showed me the whole supply side. And which is a lot harder to figure out, but show me the tools for that. All leading up to this, because we're going to apply that all. And you were able to talk with Scott, right?
He sent, we asked him, we want to do this market analysis from his perspective. And so we needed to know, is he an office leasing broker? Is he in multifamily? Like what type of real estate is he interested in? And he's a like RV park, mobile home park guy. Now, unfortunately, with the supply side tools that we have, I don't have any reports on mobile home parks and RV parks specifically.
Oh, okay.
We're going to analyze the Melbourne, Titusville. We're going to analyze that metropolitan statistical area from the point of view of multifamily.
Oh, okay, great.
So apartments. We're going to look at apartments.
Okay, cool.
And we're just going to go through all these different things that I would look for. And to be honest with you, I kind of check all these boxes when I'm looking at a new market, but I don't generally do these in any particular order.
Okay.
So I don't have any real order here. We're just going to start to gather information, and then we're going to make some. Draw some conclusions.
Yes.
Draw some conclusions.
There it is.
Actually, we need to get online.
Yeah, let's get online.
You can see what.
I've got a song stuck in my head.
What song is it?
Do you happen to have one in your head?
Nope.
Oh, yeah. It is Push It Real Good. I have no idea why. Push it real good.
Was that TLC?
Yes, I believe. Salt and Pepper?
Salt and Pepper. Yes.
Could have been either.
So let's just start gathering some information. All right. I'm going to share my screen here.
And this might be a stupid question, which is why I'm here, actually. Who would be doing this work that we're about to do?
Somebody like me, all right, who's looking to invest in a market. All right. This could be an analyst for a big firm or a big investment.
And when you say somebody like you are an investor, but you are also a broker.
I would suggest all brokers do this on their market so that they can speak the numbers of their market.
Sure.
Okay, this is a great way to just become an expert in your market. But as an investor, this is a great way to make decisions on, should I invest in this market? Mm. So many people will analyze a piece of property. Oh, that's a good deal. And they don't analyze the market. Well, that piece of property lives in a market. And the only reason that piece of property is doing well or poorly is because of the market that it's in. Mm. So, if there's a big factory closes down and there's a lot of job loss in that market, well, guess what? Demand for space goes down for everything. Mm. And so you want to understand the market that you're investing in. And if you just look at the deal you're considering, it's like drawing a conclusion without the context. Mm. And it's just so easy to make a mistake. So this is analyzing a market before you even look at a piece of property.
Yeah.
Or sometimes it might start the other way. Somebody might bring us a deal and we like that deal. So then now that there's a piece of property that we might be interested in the market, now we're going to go analyze the market, make sure we like the market. If we don't like the market and we love the deal, we're not doing the deal. Any kind of investor should either have somebody on their team that can do this, or somebody that can reach out to that can do this, or they need to be able to do it themselves.
Yeah.
So I'm going to log on the site to do business here, and generally the first thing I'll do anytime I look at a market is I'm going to run 2 basic reports on the demand side of things and get a feel for what we're looking there. So I'm going to log into Business Analyst. I showed this 2 episodes ago.
Which you can watch there. Highly recommend you watch it. It's such a great one.
And I think, so I've already got this highlighted. So this is the Palm Bay, Melbourne, Titusville, Florida Metropolitan Statistical Area. All right, that's what it is. You can see it on the map.
You could be a rapper. The way that flew out of your mouth.
But let me just clear the map, and I'll show you how I got there in case somebody wants to use Site to do business to do the same thing. So I'm going to go to Define Areas, and you could draw a polygon. I could just draw it if I wanted, but that would be a functional geography, and I want a formal geography. Yeah. So I'll choose formal geography, select from map.
Those would be like the boundaries that the government has set up.
Yep.
Or state, the man.
And then I'm going to tell it, I want the MSA that I'm going to click on. So I'm going to choose metropolitan areas, and it says click the map to select the metropolitan area. So I'm going to click here, and it's going to give me Palm Bay, Melbourne, Titusville Metropolitan Statistical Area.
Hey, there it is. Okay?
So that's how I chose my geography. Now that I've chosen it, I can run some reports. And so I can go over here and click Run Reports, and the 2 that I generally start with are Business Summary and Executive Summary. And so click Run All, and let's look at the Executive Summary first. So here's some things right off the bat. We're looking at a metropolitan statistical area that has about 627,579 people. Okay.
Wow.
It's grown significantly over the last 3 years. 21,000 people in the last 3 years. Explain that to me, by the way. From 2020 to 2023, why did 20,000 people move to what's called the Space Coast?
Yeah. I know a lot of people have been leaving California. It's like taxes and stuff. I know that there might be a specific reason that you've got in mind. Would it be COVID? COVID. People went to Florida.
Florida stayed
where COVID
open.
dies. Yeah.
No, they didn't have COVID in Florida.
No, COVID dies in Florida.
Yeah.
Because of the sun.
But they acted like COVID didn't exist in Florida. They basically stayed open, and a lot of people moved to Florida because of that. Okay, so that's not going to explain 21,000 people, but that explains a lot. They had a lot of population growth, and if you look in the last 4 years, still over 1% a year, that's a significant population growth. Okay, some other things that I'm looking for.
That was annual rate.
Mm-hmm.
Is that talking about population?
Mm-hmm.
Yeah, okay.
Yeah, annual population rate. And, you can see median age, okay? The median age in this area is older than me, 48.6. Mm-hmm. It's old. What's that tell you? People retire here.
It's Florida.
I mean, it's almost 10 years older than the median age in the United States.
Sure, yeah.
Right?
No surprise there, really.
So you can see race and ethnicity, number of households, okay? So since we're looking at this from a multifamily perspective, we care about number of households, right?
Yes.
Because people don't rent housing units. Households rent housing units.
Right.
So how many households do we have here? I'll just make a note. We have 267,699 households, and the average household size is 2.31.
Oh, yeah.
Right, so 2.31 people per household.
Grandma, granddad, and their little cat.
Mm-hmm. And they've got some money, and look at the percent of income they spend on their mortgage. It's less than 30%.
Oh, yeah.
That's really low.
Especially compared to Boulder. Remember, that was 100%.
Yeah, 100%. That was weird.
But that average age was like 26 or 28.
Now, median household income is $67,050. All right, but the average household income is $96,724. So what's that tell you?
That tells me there's some high earners in the area.
Yeah, that you've got some high earners that are skewing the average higher. But if you take the center point of the data so that half the people make more and half the people make less, that's 67,000.
Yep.
All right, good. This GINI Index.
Thank you.
I looked up what this was. Because
Yes.
last time when we looked at it, I was like, I've never seen that before. I don't know what it is.
And I looked it up, but you already moved on.
Oh, yeah.
Yeah,
So
I think I cut it out of the episode. I was like, he's not listening.
The GINI Index measures, how do they put this? Okay, if it's a 0, then everybody makes the same amount of money. Mm-hmm. Okay?
Yeah.
If it's 1, one person makes all the money and everybody else makes $0.
Oh, yeah.
So it's a percentage, and since this is 41.5%,
Oh.
that tells me that you've got some high earners, but it's still fairly dispersed.
Right,
Okay?
right.
It's a distribution of the income is fairly diverse, but you definitely have some high earners and some low earners.
That's a great index, or that's a great...
That's pretty interesting. I've
Yeah,
never
yeah.
really seen that before. I actually looked up what countries had the highest GINI Index.
Oh, yeah.
And the highest is South Africa, and there is 63.
And that would be the most equal distribution.
The most equal would be 0. The highest is the least equitable distribution.
Oh, okay.
So if 1 or 100% means one person has all the wealth and nobody else has any,
That's 100%.
the 100% or the 1, a 0 would mean everybody has an equal amount of income. All right, so the closer you get to 100%, the least equitable distribution.
Gotcha.
Okay, so
South Africa.
South Africa is 63. They're the least equitable distribution of income of any country in the world.
Oh, wow. Yeah, okay.
And I think the United States is somewhere in the low 40s.
Oh, really? I think it'd be pretty higher, but I guess, yeah.
So anyway.
Interesting. Okay.
Then we have...
For our friend Pierre there.
Mm-hmm. That's right. So another thing I want to notice here is it says currently 68.8% of the housing units are owner occupied, 20.8% are renter occupied, or in other words, about 21% of the people here rent. So I'll just go with 21%. That's a number we want to, that's actually pretty low.
That's pretty low, yeah. Okay.
Currently in the U.S., 31% of housing units are renter occupied. Okay. Now that's the executive summary. Just get a brief overview.
That's lower than I would think too. Interesting. Yeah.
Now let's pull the business summary and get an idea of.
You probably knew all that though.
Well, no. In this MSA, there's 26,000 businesses. Okay. 238,000 employees.
Will you do this with your arrow?
Oh yeah.
Yeah.
So like there's 26,000 businesses.
Yeah, okay.
Total employees 238,000 and the total resident population is 627,000, or in other words 38% of the population in this area are working.
A lot of retirees?
A lot of retirees. So the population to employment ratio, which is a key ratio for economic base analysis, you would take the total population and divide it by the total amount of employees. So we'll take 627,579 divided by 238,740, and that gives us 2.63, PER of 2.63, the population to employment ratio. Okay. Now, we're going to take a look at, I'm going to skip down to NAICS codes. So this page right here, and let's just see how diversified this economy is. All right. So I'm going to roll down. I'm looking at percentages of employees and percentages of businesses. And we could say in retail, there's about 13.1% of the businesses are in the retail category. And they employ almost 15% of the employees. You know, I've seen higher than that. And then we have another here, which is other services. That's 12%. And then there's nothing else here that's really even double-digit percentages. So right off the bat, just looking at this, thinking how diversified is this economy, you don't have any one category that's just a major chunk of the economy here. So it looks pretty diversified to me.
Yeah, it does.
You know, 4% finance and insurance, real estate, 6%, professional, scientific, and tech services, 9.2%, 8.1% in healthcare and social assistance, 6.7% in accommodation and food service, so like hotels and stuff.
Oh, wow.
So this looks like a very diversified economy. Now, I like diversified. Just think about Vegas.
Yeah.
You know, a huge part, like a third of their economy is tourism and gaming and accommodation, like hotels, hospitality, retail. You know, a third of their, and so when COVID hit and the world shut down, they got crushed.
Yeah.
You know, I bet this MSA right here did not get crushed like that.
Right.
They're very diversified. And that's what you want to see when you, because the more diversified an economy, the less risk is there.
That makes sense.
And so right off the bat, I'm thinking, all right, there's not a tremendous amount of risk in this area. It's also in Florida, so it's a business-friendly state with no income tax. They generally stay open when pandemics hit. You know, they're just more of a pro-business, regardless of how you think about that policy. It's a pro-business environment.
Yes.
That makes me feel better about this economy as well.
Okay.
So right off the bat, I'm just seeing how diversified is this economy. It looks like it's pretty diversified.
Cool.
All right. Okay. So let's look at some supply side data here. All right. So I'm going to log into Moody's Market Pro. The site to do business, those two reports, I just pulled some demand side data.
Okay.
We're looking at demographics, jobs, you know, people and jobs, the stuff that drives demand.
Right.
Now we're going to look at Melbourne, Florida on the multifamily. So I'm going to go to the actual map here because I want to download that REIC report. Nope, that's not what I want. Let's go all properties, type in Melbourne, and it'll take me there. And if I go to type and click multifamily, here's all the multifamilies. And then when I click on one and go to view details, scroll down.
Cinnamon.
Performance.
Cinnamon. Down boy. Cinnamon. Cinnamon. Cinnamon.
What is that from?
That's from Step Brothers. Their neighbor's blind, and he's got a dog named Cinnamon. He's just like, Cinnamon.
Let's find a real nice multifamily property here. All right, this looks like it'll work. Scroll down to view details, go to performance, and then reports, and then REIC. There's an error. Why is there an error when we're recording? Hey, REIC market report. All right. So here what we're going to look at is the supply side data from Melbourne. Okay.
Okay.
And this will include, there's our same, it goes from Titusville to Palm Bay, but they call it Melbourne. So it's that same, you can see that's the same
map.
Same map we pulled the demographics from.
Yeah.
We're looking at the same area, which is what we want. And then let's take a look at the executive briefing here. So overall, average asking rent is $1,464 dollars per month. Now this is everything: A class, B class, C class.
It's just the average of everything.
Just the whole average of the market, and their overall average is 4.6% vacancy. Right.
Not bad.
Now, that really doesn't tell us much until we start to disaggregate the data. Like, I want to know what Class A rents are. I want to know what Class B rents are. I want to know what the vacancy rate is for the Class B and C stuff versus the A. They're different. Okay,
yeah,
so when you
sure.
aggregate it all and you get the average asking rent for the whole market for everything that's multifamily, it really doesn't tell you a tremendous amount.
Right.
But we will be able to disaggregate it.
Okay.
So market overview. Summary of key real estate supply and demand metrics reveals that during the first quarter, the Melbourne apartment market recorded positive net absorption, which means what?
We're filling up vacancy.
Yep, there was some vacancy and it filled up.
Mm-hmm.
Okay. Unchanging effective rent, so rent stayed about the same and no movement in the market's vacancy rate. Okay. So there probably wasn't much absorption at all, but it was on the positive side. It's important to examine each of these critical blah, blah. Okay.
Don't condescend to me, Moody's.
Let's look at this competitive inventory. Net new first quarter household formations in the Melbourne metropolitan area were 1,110. Or in other words, there's 1,110 new households in the Melbourne area in the first quarter of this year.
Okay.
That's 1,110 households of demand that weren't there the previous quarter. It's a pretty big number for a place that only has 627,000 people living in it. Portion of newly gained households become tenants, all right? So they don't all buy, some of them rent. We understand that percentage is generally around 21%. Therefore, it's prudent to consider long-term economic and demographic performance. Since the beginning of Q2 2014, okay, last 10 years, households formations in Melbourne have averaged 1.6% per year, representing the average annual addition of 4,200 households. Right. Now, we looked at population change, and they averaged a little over 1.1%.
Yeah.
But household formations has actually been almost 1.6% per year.
Okay.
Right. And households are what we care about when we're looking at multifamily.
Right.
Because households rent housing units.
Yes.
So they've averaged about 4,200 households a year. But during March, all right, so just March of 2024, net absorption totaled 6 units. Just 6. So there was positive absorption, but just barely.
Yeah. Right.
Which didn't change effective rents, which makes sense. There was just 6 units absorbed. And it didn't change the vacancy rate because there was just 6 units absorbed. That didn't change the equation at all.
Gotcha.
Right? And no new development. So no new supply of units was introduced in the market first quarter of 2024. Over the last 12 months, market absorption totaled negative 132 units. So 132 units were occupied and became vacant over the last 12 months, right? In comparison to the absorption rate recorded since the beginning of Q2 2014. So average, there's been absorption of 403 units on average per year over the last 10 years. But the last 12 months, it went in the opposite direction. 132 units. Okay. In a long-term context, March vacancy rates 0.5 percentage points higher than the 4.1% average recorded since the beginning of Q2. All right.
2014.
And when we looked, it said 4.6% vacancy is what they had. That's 4.1% average plus the 0.5. It's 0.5% higher.
Okay.
But still, and 4.6% vacancy is for the whole market. That's really low.
Yeah, that's low.
That's low.
Right,
There's
yeah.
not a lot of inventory available to rent. Okay. Income growth is growing at the same rate that it's growing nationally. All right. Job growth is up 0.1%, but it's down 0.3% nationally. Right? And this is kind of a chart that shows the same thing. Here's vacancy and asking rent. You can see what that's doing. One of the things I want to do here is look at long-term average vacancy. I want to get a feel in this market of how much vacancy does this Melbourne MSA actually need to operate efficiently.
Yes.
And so there's a really cool way to do that.
Yeah, let's take a look. Let's take a look in the past 10 years.
So I'm going to go to the data hub here. I believe this is where I go. Yep. Check multifamily. And then the Melbourne Melbourne, Florida. It doesn't have any submarkets. And I just want yearly data. And let's download this bad boy and open this sucker up. And let's see what it tells us.
Let's find our little ticks where it switched from negative to positive.
That's right.
Yeah.
Now, this goes back the last 20 years. Okay. And they're forecasting the next 10 years. So here's the actual data we have. All right. This is apartments, all building class. So A, B, and C. This is the whole thing. This is how much inventory they have. This is how many completions they've had. So if you take, we had this many, add 240, and there it is. Or actually, you had this many, add 240, and you have that. Add 396, you get up to 16,000, you can see. And then you can see what the vacancy is. Okay? So look how the vacancy, if you go back to like 2008, I think that's 2008, they were at 12.4%. They had 400 units added that year, 12.4%. And then, and you can really see people started moving and absorbing those units. Here's vacancy change. You can see, this vacancy drop. And from these years right there was no new development, no new units until you got to 2016. And then they started building again. And in holy moly, 2020, they introduced 1,364 units.
Wow. Very, very interesting.
And then all those people in 2021 that wanted to live somewhere that was open had a place to go. So you can see even after they introduced almost 1,400 new units, their vacancy rate the next year was 3.6%. They built another 500 units, then another 500 units, and then in 2023, 245 units. And they're still, right now, at this quarter, 4.6%. At the year end, 2023, they're at 4.5% vacancy.
Yeah.
So they're introducing all these new units to the market, and people are renting them up.
Right.
They're being absorbed. And so when you scroll over a little bit.
Renting or buying or both?
Is
this specifically renting?
Yeah, these are apartments.
That are being rented.
These are not housing units. These are apartments being rented. Okay. So you have net absorption. You have asking rent. Okay. Asking rent percent change. Now, normally we look at a market and we say, we want to identify where the rent, the asking rent, where it went from positive to negative percent change. Only you hardly see that at all here in the last 10 years. So if we go back to 2007, we had positive here, and then we go negative here in 2009. That kind of makes sense because 2009 was the great financial crisis. Then we go back to positive again here. All right.
Housing
Then it's
bubble.
positive, 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 positive. Look at asking rent change in 2018. It went up 12%.
Wow.
Then 6%, then 3%, then 15%. When all those new units were introduced in 2020 and 2021, all that demand was going to Florida. They wanted, I guess, to be in a place that was open.
Right.
Right?
Yeah.
All this new construction, all this new supply, all this new demand. And when there's a bunch of demand, what's that do to prices?
It goes up.
And it went up a lot, 15.2% that year. And then the next year, it went up 16.2%.
That's
a tremendous amount of rent growth. And then the next year, what do you have?
-4.
So in 2023, asking rents dropped by 4%.
420. To be specific.
Mm-hmm. Yeah, I know what you're doing there. All right. So generally what we would do is we would look at when we had these inflection points on asking rent percent change, and then we would scroll back over here to vacancy. Let me do this.
And when we did this before, there was more of a pattern and not such a big gap like we're seeing here.
Yeah, and here you just had a lot of rent growth because there's just so much demand over. So it'll be a little bit more difficult to decide what the asking rent, what the actual vacancy rate should be. Mm-hmm. But you have an inflection point here at 12.5%. Okay. And then you have one here at 4.5%. But what I'm seeing over the last 10 years, let's just look at the last 10 years. And you've got a high of 6.4 and a low of 2.5% vacancy. And, I think your average vacancy rate over that change, or like your natural vacancy that you need, is probably somewhere around 5%.
Yeah, about where it's at.
Yeah, I think it's probably pretty close. So let's just say long-term average vacancy, or that natural point of vacancy that this market needs to operate efficiently, I'd say would be at least 5%.
Yeah.
Okay. And anytime you see it lower than that, I would expect to have a lot of rent growth. But in this case, since there was so much demand for a period of a couple years, you had all that crazy rent growth. I mean, that was, when we saw that in other markets through COVID, is people left some places and they flocked to other places. And this looks like one of the places that people flocked to.
Yeah. And
it caused a lot of rent growth. And now it looks like that's coming back down. So as we forecast moving forward, we had that big 16.2% effective rent change, rent growth. Then this year, or 2023, it dropped. 2024, they're projecting that it's basically going to remain the same this year. That's a little bit of an indication of equilibrium for the year.
Uh-huh.
And so that's 4.7% vacancy. So I feel better about my 5% being sort of the equilibrium amount of vacancy that's needed. So I think we're pretty good, somewhere in that 4.5% to 5%, but I'm just going to say 5%.
Okay.
All right. And then they're projecting going forward that we're going to have 2% rent growth, 3.5%, and then a little over 4%, taking us to 2033. So that's just what they think the projections are going to be.
Yeah.
Okay.
It almost seems like it's kind of settling, right? Like you shook up. Michael J. Fox handed you a Diet Coke. You opened it up. And now it's just kind of similar. I can only say that because he did that in Curb.
Yeah.
Okay. He's like, did you shake that up on me? Or was that, no, it's Parkinson's. It's Parkinson's.
I love Michael J. Fox.
I do too, yeah.
Oh, dude.
Oh, did you notice the cards were Back to the Future?
Nice.
Yeah.
The DeLorean.
Yeah, the DeLorean.
Back to the Future.
Back to the Future.
Great movie. So, all right. Now, if we go to market transactions, now what you're going to see is here's 2023, back 20 years-ish, 2025. And here's the number of transactions, 14. 14 apartment deals happened that year, and then 6 and 3. And
that seems very small.
And then 2021, there were 15. Then there were 12.
That's it? Like,
This isn't a huge place.
but that means like 14 apartment deals, 14 people moved into an apartment?
No, 14 apartment complexes sold
That makes more sense. Yeah, okay.
for $400 million. So in 2021, 15 apartment complexes sold for $400 million. The mean sales price of those deals was almost $27 million. So mean is what?
Average.
Yes. Median sales price was $12 mil. Mean sales price per unit was $210,000 a door. And so this gives you some information. And then here's what the 10-year treasury was at that point, which gives you a little bit of a feel for what interest rates might be doing or the cost of capital. Now, if you scroll down here a little bit further, now these are just Class A deals, right? So now it's segmenting them out. So Class A deals in 2021, there were 15 that year, I think. But only 3 of them were Class A deals. And there was 400,000 in sales.
Yeah.
For 400 million in sales. But 3 deals were 167 million of that 400.
Oh, wow.
Mean sales price per unit, 244,000. Then down here are the B and C units. So in 2021, there's 12. Out of those 15 deals, 3 of them were Class A deals. The rest of them were B and C deals. 12 deals at 233 million. You can see their mean sales price per unit. It's 186,000. And then you can compare this to the region and to the U.S. So this is just some really great supply side data. You can see what's in the pipeline. New construction listings.
Oh.
All right, so data as of 2024. These are all 2024 deals. Here's the property names, addresses. All right. How many are groundbreaking year, completions per month, completion year, size in units. So you can get a feel for the pipeline with this data as well.
All right. Well, what's this telling us now that we've segregated it out?
I think we still need some more information before, but we've determined kind of what amount of vacancy this market needs to function efficiently, somewhere around that 5%. We can see asking rent. We'll come back to this data in a minute, but let's pull some other information.
We're just gathering.
We've never talked about shift share analysis here, have we?
That sounds familiar. I think
I've
we have.
said it before, but we've never done an episode on shift share. So let me give you just the.
Okay.
Maybe we'll do an episode at some point, but let me just give you the high level.
Okay.
Okay. Shift share looks to the past, to the present. Right? You're looking back, and you're going to analyze a market based on the amount of job growth that they've had over that period of time, however many years you're looking back.
Okay.
And then what you're going to do is you're going to try to explain that job growth or decline based on 3 factors: national growth, industry mix, and regional shift. Right? National growth says the United States grew by 6%, job growth by 6%. Then this market you're looking at is in the United States, so it should grow by 6% as well because it's part of the United States. So you're going to allocate that percentage of job growth to just because it's in the United States.
Okay.
The idea of a rising tide lifts all ships.
Okay. Yeah.
So think of it this way. We're going to take
Great image.
all that national growth jobs. We're going to put that allocation of why we had that growth or decline. We're going to put it into a bucket. Right? We're going to set that bucket over there in the corner because we want to peel that layer off. Right? We're just going to put it over there.
Okay.
We don't need it. We just need to segment it off so we can see what's below it. The next layer is industry mix. And so we're going to look at how those industries did nationally over that period of time we're looking back. And we're going to say, okay, because those industries did that amount of good or bad, there should be this amount of growth or decline within this market because they have those industries. And you take that layer off and put it in a bucket, and you put it over there in the corner.
In the other corner.
Because we want to see what's below that. Okay. So we've allocated a certain amount of growth or decline to the fact that we're in the United States, national growth, and because there's these industries in our market, and this is how they've done nationally, so we would expect that to affect here. We've taken those 2 layers off. We've put them in buckets over in the corner.
For
and
privacy.
What's left is the regional shift, What this tells us is people have come to this place for jobs because of some reason that has nothing to do with industry mix or national growth. It indicates that this market could have comparative advantage over other markets. So think about Austin, Texas is a great example. They have some comparative advantages there, right? They're in Texas, which is incredibly pro-growth, pro-business, no income tax. Those are some comparative advantage that Texas has. But Austin has become a tech hub. And so there's a tremendous amount of highly skilled tech people, and there's a lot of tech jobs. So there's a tremendous amount of depth of talent in that market. That's a real comparative advantage. So what we want to see when we look at regional shift numbers, if there's really big numbers in certain industry sectors, then there's something going on there. There's some kind of comparative advantage there. We don't know what it is. We just know that there's comparative advantage when we run a shift share analysis. So let's do a shift share analysis for Melbourne.
All right.
Palm Bay, Melbourne, Titusville, MSA.
Palm Bay.
And let's go back to before COVID, 2019. And the most current data that we have is the second quarter data of 2023.
Okay.
Now, let me ask you this. Based on what we know already, this is just looking at jobs. All right. And what do we know about this MSA when it comes to jobs?
There's a lot of retirees.
There's a lot of growth there that has nothing to do with jobs.
Yeah.
People are retiring there.
Right.
And they're not working.
Right.
So just keep that in mind.
Okay.
So we're going to click Run Shift Share Analysis. And there's
other markets where people are flocking to it for the jobs.
Like
such as Austin.
Or Nashville. Or some other places like that. So I'm going to go to the data table here. Now, I just want you to focus on these three categories: national growth, industry mix, and regional shift. And here are our NAICS codes, our 2-digit NAICS codes. We call these super sectors. And so let's see if we have some regional shifts, some big numbers here. Okay, so in construction, there's a pretty nice growth rate there. All right, they probably have some kind of comparative advantage. Here in manufacturing, all right, they went from 26,000 jobs in manufacturing to 33,000 jobs in manufacturing. All right, and 6,600 of those fall into that regional shift category. Okay. So that tells me there's some kind of comparative advantage there. None of these numbers are that big. Professional, scientific, and technical services, that's, over a 5-year period, 1,200 jobs in just that amount. Okay, they probably have comparative advantage there. This pulls from BLS data, and BLS data struggles with this public administration and unclassified section. See how these are all zeros?
Yeah.
This data table is telling us that there are 0 jobs in those categories, and that's absolutely not true.
Yeah, okay.
They do have government jobs, public administration jobs.
Yeah.
Okay, but it's not picking up on that here. So we could be missing some data that we have to just go dig for somewhere else.
Okay.
But it does look like they have a little bit of comparative advantage, especially in manufacturing. Now, the one thing I know about this area of the country is it's called the Space Coast.
That explains the professional, scientific, and...
Potentially. And in NAICS code 925, I think, are like space jobs.
Huh.
And it's not showing up here. So I think there's a tremendous amount of jobs in this MSA that aren't showing up in this data that we're pulling.
Yeah.
And so we would need to recognize that and go figure it out. Now, maybe it's I need to start calling some people I know in this area who are experts and have them fill in the gap, even if it's anecdotally. Space launches are going on there and stuff. It's like, they call it the Space Coast. So we're missing a lot of that data. All right. Now, this is a shift share analysis. And what all I do is I roll through this regional shift category, and I see where they have comparative advantage. Now, one interesting thing is you have all those retirees going there, and they've actually lost 3,800 jobs in healthcare and social assistance.
That's you would expect it to go the other way.
Yeah.
Right.
So nationally, it should have grown 1,250 jobs just because it's in the United States. The industry is growing, but something about it here isn't. I'd want to ask somebody about that.
Yeah.
Somebody that lives there and understands what's going on. There's something going on in the healthcare sector down there that I don't understand.
Yeah.
Maybe it's becoming regionalized, and those jobs are in Orlando, which is not that far away.
Yeah.
Maybe they're becoming a lot more efficient in their healthcare, and they don't need as many people. I have no idea. But this would be that number, that negative 3808, that's a question for me as I analyze this market, and I would need to go find an answer.
Yeah.
So what ShiftShare does is it gives you a feel of where there might be comparative advantage or some other places that could be some red flags.
Right.
And it shows you where you might need to dig more.
Right. Right.
That's the advantage of a ShiftShare analysis.
Go ahead.
Well, in 102, when we're teaching it, we do a whole module on economic base analysis and ShiftShare analysis, and it's basically a whole day of the course. And, we'll spend a couple hours teaching the students how to do a ShiftShare analysis with pen and paper, essentially, and a calculator.
Yeah.
And then after that's done, we show them the easy button, which is this website. Like, here's how you do it in real life. Now that you understand it because you've done it.
Right, right.
Here's what these numbers tell you, and here's how you can get them just like that.
Yeah, yeah.
But what were you going to say?
I don't remember.
Great. So,
thank goodness.
so this market as a whole, it's got some comparative advantages. It's certainly got a lot of population growth, but not a tremendous amount of job growth from 2019 to 2023, 192 to 209. That's 17,000 jobs. That's a pretty good number, okay? And about a third of them look like, maybe 35% of them are based on regional shift. So people want to live there is what that tells me, all right? And that makes me lean positive towards this market. So ShiftShare looks in the past to explain the present, right? It gives context. Now, economic-based analysis uses today to predict the future. So let's do a little economic-based analysis.
There we go.
All right. Now, this actually does it for us. If you remember, economic-based analysis divides jobs into two categories, which are what?
Basic and non-basic.
Yes, and a basic job is what kind of job?
It's a job that brings money in from other states or areas.
By, how do they do that?
By distributing out. Outsourcing, not outsourcing.
Okay, you're right there.
The goods are going out. The goods,
What they create, goods or services, they export outside of their local economy, and they bring new dollar bills into the economy.
New dollar bills.
Which are very important. Those new dollar bills, very important. And basic jobs have a multiplier effect. Okay? And what are non-basic jobs?
Non-basic jobs would be a broker, a barber. They circulate dollars within the community.
What they do circulates the dollar bills that are already in the community. They serve the community itself. They don't do something that exports goods or services outside and brings new dollar bills. What they do is they serve the community. Their goods and services are consumed within the community, and the dollar bills that are already in that local market just get circulated around. And every time they're circulated,
it dwindles a bit.
It dwindles because of
taxes
and
savings.
Yes. Savings, investment, taxes. Doing great. You want to bring in basic jobs because they have a multiplier effect. And every basic job you bring in will create more non-basic jobs. All right. So when you run an economic-based analysis, what you do is you figure out how many basic jobs are in a market and how many total jobs are in a market. And then you can figure out what that multiplier is. That multiplier is called economic-based multiplier, EBM.
EBM.
All right. So this slick little tool here actually tells us two things. We can look at the super sector, the two-digit NAICS codes from 2019, but 2023, most recent data we have, says there's 8.32 is the economic base multiplier. So for every one job, every one basic job, there are 7.32 non-basic jobs. Okay. Now that's a pretty high number, right? And we're looking at the super aggregated two-digit NAICS codes. So like all of construction we're looking at, Okay. But if we disaggregate that to 3-digit NAICS codes, so we break the 2 digits into all their 3-digit categories, we can start to dial this in, and we can find more basic employment. Now, here's what's happened. Now, think through this with me for a second. When we're at the 2-digit NAICS code level, and we have these super aggregated, numbers, what we have is total employees is the numerator, and basic employees is the denominator. So when we go from 2-digit to 3-digit NAICS codes, we'll start to find more basic employment, which will increase the numerator or the denominator?
Denominator.
Denominator.
Yeah.
So as we disaggregate into 3-digit NAICS codes and we find more basic employment, the denominator gets bigger. So what will happen to the economic base multiplier if the top line numerator stays the same, but the denominator of basic employment goes up? The economic base multiplier will get smaller. So if you look at the Melbourne MSA and you say, oh, the super sector, that's sector EBM, 8.32. So for every one job we bring in, there's 7.32 non-basic jobs that are created.
Yeah. Woohoo.
But let's look at the 3-digit subsector, all right? When we go disaggregate it, we find more basic employment, we increase that denominator, that economic base multiplier goes down to 4.92.
Mm-hmm.
That's a much more conservative number to do your projections on.
Yeah.
And so you want to do that.
You want to use that one.
You want to use that one.
Yeah.
Now, in this case, if you wanted to go to 4-digit, 5-digit, 6-digit NAICS code, it's a tremendous amount of extra work, but you can dial that number even more specifically. But generally, 3-digit NAICS codes is going to be enough disaggregation to get you a really good number. But with the Space Coast, what are we missing when it comes to the job data?
The political or the government, the public stuff.
And all those space jobs.
And the space jobs.
So I would want to go figure out those numbers and then add it to the data set. And it would probably bring that subsector economic base multiplier down even more, because I bet we're going to find a lot of basic employment in those space jobs.
Yeah.
Because we've got a hole in our data with those the public administration jobs and the space jobs that don't seem to be in the data, I might take that 4.92 and take it down to like a 4 or a 4.2. Just make it even more conservative as an economic base multiplier. So let's do that. Let's say 4.92 is the subsector, but since we're missing that data, which probably would add to the numerator and the denominator, I'm going to bring that down. I'm just guessing, but I'd say 4.2. All right, so we're going to work with an economic base multiplier of 4.2 here. Now, if I were doing this in real life, I'd be calling people in that MSA, and I'd be trying to get some more specific data about the jobs there.
Yeah.
I might be talking to brokers, the mayor's office, the economic development folks, people that are dealing with the jobs there, and get a feel for, I'm missing some data.
Yeah.
Let's see if I can fill that in. Yeah.
Yeah.
Probably.
No, he better call me back. I've called him twice now.
Yeah,
well, you can tell him he just lost 6 votes.
Vote early and vote often, right?
Yeah.
Okay. So now we've done our economic base analysis. All right. We've got our economic base multiplier. We've got our population to employment ratio, which we figured out earlier, which is 2.63. Right. And so now what we want to do, we've done our shift share. We've done our economic base analysis. We've taken a look at the jobs data. We want to know market cycle. What market cycle are we in?
Yeah.
So this is fourth quarter 2023, all right, published in February 2024. So the next one may be about to be published, all right? So this just tells us top 54 metropolitan statistical areas. Melbourne's not going to be in that top 54. We're not going to see Palm Bay, Titusville, Melbourne in any of these graphs, but we could probably draft off Orlando. I bet Orlando might be big enough to make it in that top 54. So overall, nationally speaking, here's where the different property types are.
I remember
nationally, apartments are in what? Hypersupply.
Yes, they are. They have more than they need.
Yes. And what's happening here is rent growth is declining.
Mm-hmm.
Okay. So rents could still be going up, but the rate of going up is declining. And since they're above this long-term average occupancy line, they still have a lower vacancy rate than they normally do.
Yeah.
But it's trending down.
Yeah, okay.
Right. And so you would expect in the coming months, maybe the coming year, for them to drop into recession like office is. And once they drop below this line, if that long-term average occupancy that we figured out, let's just say we're right and it's 5 for Melbourne, once they hit above 5%, you would put them down in this recessionary area. Okay.
Yeah.
But nationally speaking, multifamily is at 13. But let's go to multifamily and look at the different markets. There's office.
If you were seeing this, you're like, wait, what is this? Where did this come from? There's a whole 2 episodes, part 1 and 2, you could watch right here that dives into this right here. It's fascinating.
Yep. So here's the apartment market cycles, and let's see if we can find Orlando anywhere. Yep. They're at 13 as well. Okay. So the nation is in hypersupply. Orlando's right there with the nation in hypersupply. And so I'm going to make an assumption at this point. If I were looking at a multifamily deal in this Melbourne, Titusville, Palm Bay area, I would go bear this assumption out, that what's true about Orlando would also be true for a market that's very close to it in this MSA that we're looking at. But they're at 13%. So here's what I expect to be happening in Melbourne because they're at 0.13. All right. I expect that they've had a lot of completions over the last couple of years. We, in fact, saw that that's true.
Yes.
All right. We saw a tremendous amount of rent growth, and then we saw last year, what did the rent growth do? It fell off.
Yeah.
Negative 4.5% in 2023.
Yes.
That means it's going down. All right. And if they're...
I think it was negative 420, 4.2.
Okay. Whatever it is.
Yeah.
We saw it turn down just like we would expect. And if the long-term average vacancy is 5% and they're at what?
4.6.
They're 4.6. So they're still in hypersupply. And that's exactly where. So I would, based on the data that we saw from the supply that we got from the REIC reports and Moody's Marketplace Pro, I would firmly put Melbourne at 0.13 as well. The data says it's at 0.13. Rent growth is declining, but they still have more occupancy than they normally do. If normal's 95%, they're at 95.4% or 90, like a little. They're still above that. That's 0.13.
Okay. Yeah.
So where's multifamily in the Melbourne MSA? 0.13. It's in hypersupply.
Yeah. Okay.
That's exactly what we know, and that's great. So we've identified where they are in the market cycle, and we can expect that
it'll dip before it.
It'll probably continue to go down a little bit, but it might have a real, with the amount of population growth that adds to demand, they might roll through that dip pretty fast. Okay.
Yeah.
So based on their growth, I'm not that concerned, but they're definitely in hypersupply.
Sure.
Okay. I wouldn't expect a tremendous amount of rent growth over the next couple of years like they saw the last couple of years.
Right.
That 15, 16%.
The fact that during COVID and there was so much supply added and so many people moving, that there, because of that and that being kind of unusual, that as it fizzles off or as it dips a little bit, that dip might be a little bit more severe, or it might be stagnant for longer, as opposed to getting through that dip quickly because of how much happened in a short period of time?
Not necessarily. It could happen that way. Let's say all those people that moved to Florida decide they want to move back now that the world's basically gone back to normal.
Right.
Maybe they go back. It would reverse itself quite a bit, right? And all of a sudden you're going to have all this occupancy, and you might be in the recessionary period for a longer period of time.
You mean vacancy? Because they moved away?
Yeah, what did I say?
You said occupancy.
Yep, I mean vacancy.
Yeah, cool.
Just listen to what I mean, okay? Not what I say.
I know, but we got a lot of people listening to your words.
But yes, that's correct. If they all move back, you would see some of this reverse itself. There'd be a lot more vacancy. That would put them squarely in that recessionary period. You should see rents reverse back,
right?
Or rent decline.
Yeah,
yeah, and they could be in that space until they've had enough demand or enough household formation, population growth, where there's demand now for those vacant units. So they might be there. But what we've seen so far is there continues to be household formations, population growth. And even though there was just net absorption of 6, you don't see it really in this quarter is what we found. You don't really see it reversing itself. You don't see this mass exodus there. And they're predicting continuous 1% annual population growth.
Yeah.
Actually, it was less than that, but they're still predicting population growth. So I would expect that they might stay in hypersupply for a little bit. They might get through that recessionary period into recovery pretty quickly.
What would your advice be to?
That's a great question.
Yeah.
And it deserves another episode.
It does.
Like this is the information gathering part of the market analysis.
Yeah.
But to give the analysis of the information justice, we should make it the next episode.
So the next episode is going to be what
our conclusions. Yeah.
I like that. Yeah.
A little bit of a cliffhanger, but like at this point, we've gone certainly long enough for this episode, and we shouldn't shortchange the, hey, based on this is what I see kind of thing.
No. Okay, cool.
Let's give it its whole. Let's give it its due.
Oh, man. Yeah. Everyone's waiting. What? Okay, so what does that mean?
Either that or
check
we put
back
them
next Monday.
Either that or we put them to sleep with all this data and analysis stuff. But this is what analyzing a market can look like. You're just gathering a lot of data from a lot of different sources. It's going to generate a certain amount of questions that you're going to want to go investigate. Like that shift share, really that negative 3,808 jobs on the regional shift in that healthcare space. Like, I did not expect that. So I would want an answer I would want to know what's going on there, where there was comparative advantage in those other sectors. Yeah. Like I'd also want to understand what the comparative advantage is.
Right.
It shows that there is a comparative advantage, but it doesn't tell us what it is. We need to investigate more.
So fun.
Another thing I want to know is, are there certain job announcements in this area?
Right.
Because we know we have the data that we need at this point to predict future demand based on job growth. And so we want to take the job growth that we see and do a little bit of investigation with the market. Like, have there been any job announcements down there? A 500 job announcement, if those are basic jobs, could equate to 2,500 total jobs, which could equate to another, maybe 12,000 increase in total population, which would be like, I don't know, maybe 5,000 households.
Right. Yeah.
1,000 of those folks are going to rent. And so now all of a sudden you have demand for 1,000 new apartments because of a job announcement of 500 jobs.
Right.
But they were basic jobs, so you got to apply the multiplier.
That's right.
You can start to forecast. So we'll see if we can't find some job announcements if there has been. Scott, if you're listening, and there have been some significant job announcements, let us know about that. We'll see if we can find it on our own. But then we can predict demand in multifamily and what we can see coming in the future. And that's where you can make some decisions that make you some money.
Yeah, baby. And that's what this is all about, making decisions that make you money. Bottom line.
We're not trying to lose money.
No,
right?
Never.
We're in the real estate business to generate wealth, create cash flow so that we can give the way we want to give, so that we can support our families the way we want, so we can. Money's not the thing. It's the good in the world you can do with money once you have it.
Sure. Yeah,
you know? And some people just want the money. I get it.
Right. But bottom line, no matter how you slice it, people are in business to make a profit.
And this stuff allows you to make wise decisions.
Yeah.
That increase your potential upside and mitigate risk.
It gives you that competitive edge going through. Where'd you learn all this? CCIM?
Mm-hmm.
Yeah. That's good stuff. The only question I had that came up that I wanted to ask was, when you saw that the healthcare jobs went down or whatever, you're like, I'm going to call somebody, another broker or mayor. Would you just not start off with a Google search before making any calls? Just quickly do a Goog.
If I felt, I wouldn't in this case because I don't really know what I'd ask Google.
Right.
Why were there job losses in this industry sector in Melbourne, Florida?
Right.
Like, I don't know. I wouldn't expect to get a real answer there.
Right.
And so I might just call somebody. If there was a question
You're
about
so
something.
Gen Z. I mean, Gen X. Wait,
Yeah,
Gen X.
I'm an Xer.
No, I'd much rather call them. No, I'm not going to Google. I wouldn't even know what to type into the computer.
Two nights ago, I'm driving home.
Yeah.
I've got Maddie in the car. I picked her up from the health park where she was doing her basketball stuff. We're driving home, and I call our friend Scott Overby back.
Yeah.
Okay? And we have a conversation that was really exciting to me. We were talking about fees and big deals. One of our buddies, friend of the show, Robbie.
Yeah.
From Austin.
Yeah.
We were talking about something he was working on and stuff, and we were getting all excited and stuff. And I hung up. Maddie's sitting right next to me. She's on her phone, whatever. I look at her, and I was like, you can't tell me that's not fun. And she looks at me like I'm insane.
Yeah.
I was like, did you hear any of that? And she's looking at me like, you were talking on the phone, and you think that's fun? I was like, baby girl, I get to have all kinds of fun. And she's like, I do not want to talk on the phone. It was the idea of having a audible conversation through a technology device was just like, it was
right.
And then she sends a meme to Autumn later on that was something along the lines of, it showed a mom talking on the phone and the daughter sitting in the passenger side going, I'm in hell or something like that.
Yeah.
Because she had to listen to a phone conversation or whatever.
Right.
And I'm thinking, man,
yeah,
I have all kinds of fun on the phone.
Yeah. Right.
But I'm dealing with people that I care about. I like them.
Right.
We're doing exciting things.
Yeah.
Sometimes I'm on the phone and I'm not having any fun.
That's right.
Talking to somebody that, maybe there's conflict or, it's a tough conversation or something. That's not fun. But man, the fun we get to have in commercial real estate, trying to figure out problems and put deals together and
that is
do
fun.
Big things. It's a lot of fun.
I mean, I'm seeing how fun this is. Just putting on your investigator hat now. It's like right here, you really are becoming an investigator.
Yeah. These numbers are uncovering questions that we got to make some assumptions on the front end. And then based on how
apply
we
the scientific
feel,
method.
Based on how we feel, if we want to move forward, we got to bear out those assumptions. So we have to go investigate and turn those assumptions into hard numbers.
Right.
And you become an investigator
or a scientist. Scientists do the same thing.
Yeah.
I think we talked about it on one of our first episodes. I was like, the scientific method. And you're like, I guess so. Yeah. Where it is, you make an assumption, and then you test it to see where you're wrong. Right?
Yep.
And go to where you are seeing that's right. Yeah.
Next episode, what we'll do is we'll look at threshold rent. We'll figure out in Melbourne, let's say we can forecast demand. And we could decide, hey, a developer should build because there's demand coming.
Yeah.
Okay.
Right.
Vacancies, very, very low. So there's not a lot of vacancy. There's people coming. They need more units. Okay. We'll be able to tell them based on the incomes there what the threshold rent is.
Yeah.
Based on how much the people make in that area.
Yeah.
And so then a developer can say, all right, if I build it, I should be able to get $1,500 a month per unit. And if I can get $1,500 per month per unit, then I can make a profit if I can build it for this amount.
Right.
And so that's an analysis we'll do next time based on their median income. How much rent can they afford to pay?
Right.
Because, man, if you're a developer and you build 400-unit apartment complex and it's great, and for it to make sense, you need people to be able to pay $2,200 a month.
Yeah.
And the people that live there can only pay $1,600 a month. You've just made a huge mistake, right?
I've made a huge mistake.
So you can figure that out ahead of time. I'll show you how to do
on
that.
the next episode of Commercially Speaking.
I like it.
Well, if you're watching on YouTube, hit subscribe, ding that little bell, leave us a comment of some things that you might want Bo to teach me. Leave a review on Apple Podcasts. It helps us out a great deal. We love it. We appreciate it. We've got a free weekly newsletter. What can they see on that?
Subscribe.wgbaron.com. It's a newsletter that provides the latest episode of Commercially Speaking. And then it's actually curates some great information that has to do with real estate and business in general. So it could be leadership, could be negotiation, just some great articles from really, really smart people that will just make you a better business person all the way around. Some of it commercial real estate related, some of it just business related.
Yeah, if you admire my big brother Bo like I do, this is stuff he's reading.
Yeah.
So,
Thanks, man.
yeah, absolutely. And also, Bo's going to be running some webinars with CCIM Institute called Currently Commercial. They're going to be talking about AI to start, just to make sure you don't get left behind in this market. And as soon as they've got a place to sign up for that, that will be a part of that newsletter. So, yeah, subscribe.wgbaron.com or whatever it is on the screen here.
Yeah.
Yeah.
I think that's it.
Yeah, and we're on social media as well, at Commercially Speaking, anywhere pretty much. And yeah, I'm going to start putting our episodes on Twitter.
Nice.
Yeah, all of our podcasts and episodes, because we can do that now. And Elon
We'll just
Musk.
do the whole thing.
Yeah.
Cool.
How much is that going to be? And then also I'm going to do it on Facebook too. We're just going to put it wherever you all are, and where you like to do it. So please share it with people you know, and we'll see you next week for the conclusion of, well, what do we do with this information now? What does this mean? And not meaning average. What does it actually mean?
Yeah.
All right, cool.
All right.
All right, love you, brother.
Love you, man.
Bye, Alice.
See ya.
Hey.